When we look at the artificial intelligence and data analytics space, there is no question these two industries are going to be growing for the next decade, with Palantir having the potential to be a major player in both of these spaces. But with the company having their valuation cut in half over the past year, is this company really a buy here in 2023? Well, in this video, I want to share my thoughts about Palantir's recent news and whether or not I'm buying this company or not. But I don't want to waste your time, so let's go ahead and dive right in. So looking at the price action, Palantir at one point hit a low back on May 11th, and it seemed like the company was done falling as it went on a really nice run. But after the stock hit over $11 on August 5th, the stock plummeted to a new all-time low around $5.90 on December 27th. And now the company is trading somewhere around $7 a share. So it's clear that there has been a good amount of volatility with this company. But does Palantir have more room to fall? In order to truly assess this company, I want to come at it from the following factors: the company's financial position, growth, margins, and profitability. I believe that these key factors are important for assessing not just Palantir, but any company that you are looking to buy. So first, let's look at their financial position. As of Q3, the company has $2.4 billion in cash with no debt and an undrawn credit commitment of $950 million. What that tells me is that when it comes to safety of the stock, it is difficult to see this company going to zero. So as a shareholder, this gives me confidence going forward, not just because of how much they have in cash, but that they are ready to capitalize on opportunities that could arise in the current macro environment. And it is clear that they are looking for the potential to deploy that cash, and while many companies are losing money, Palantir continues to hold a good amount on their balance sheet. The company also has over 4 times the amount of current assets as they do current liabilities, which means that they can easily pay off their liabilities over the next year. And for a company like Palantir, who is going to continue to expand as far as the eye can see, they are in a position to continue investing in that future growth. One other important metric when looking at their financial position is that their $2.4 billion in cash is over 2 times their total liabilities, so they could pay off all their liabilities right now if they wanted to. So it's obvious that when it comes to the company's financial health, they are just fine. Now, there is something that I want to note, and that is their dilution. The increase in share count could be a negative in people's eyes because it lowers the shareholder ownership in Palantir, which makes it harder for share price to increase. If we look at what happened year over year, there is a substantial reduction in stock-based compensation, but we need to consider what this compensation is even for. This isn't just handing out stock to employees just cause. Doing stock-based comp helps Palantir get the top engineers to make the best products. So unless you believe that Palantir's products won't be multi-billion-dollar products down the road, then I don't see too much to worry about. And as long as in 2023 they don't decide to ramp up stock-based compensation, I don't think dilution will be a big factor moving forward. Okay, now let's talk about Palantir's growth. This is what I feel many investors are paying close attention to because Alex Karp said that he believes the company will have 30% growth for the next few years, but we did not see that strong of growth this year. In fact, analysts have the company only doing about 23% growth, which is significantly under their projection. And at the beginning of 2022, their government revenue struggled, but in Q3, we saw commercial revenue drop significantly in comparison to the prior quarter. The reality is that their government revenue fluctuates a ton, and this means that some quarters are going to have outstanding growth and others not so much. And what we have seen over the past few months is tremendous news for new and expanding government contracts. So I'm not worried much at all about their government revenue. Now, when it comes to their commercial revenue, I think it's important to consider the environment that we are in and how this affects businesses. Companies become much stricter with their capital, and this means that they won't spend the kind of money for the products that Palantir provides. But despite the environment, we are still seeing Palantir form new strategic partnerships. And these partnerships aren't in the same sector either. For example, Palantir has new partnerships with Cloudflare, Tampa General Hospital, Integrity Tool and Mold, and Crisis 24, and all of these partnerships have been announced over the past month and a half. And so when I see all the partnerships that they have, their commercial revenue growth will be just fine in my opinion. Plus, the fact that Palantir can still grow over 20% in this kind of environment is not bad at all. If you're a bear of Palantir, you would have to expect revenues to slow drastically, and if they are growing this much during a recession where businesses don't have as much money to spend, what is going to happen when they do have that money to spend? I mean, even in this kind of economy, they increased their deal value by 14% from $3.6 billion to $4.1 billion. The reality is that we are going to be moving toward more things using data analytics and artificial intelligence, and unless you believe that Palantir's product is not going to be useful 5 years from now, the company will continue to have tremendous growth in my opinion. Okay, now onto the third metric, and that is margins. With an adjusted gross margin of 80%, it is clear that the business is incredibly efficient, and when we look long term, the company has outstanding potential to produce greater cash flows, which I will talk more about later. Now, one thing that we have seen from Palantir is that the company has has continued to grow gross profits, which is where you take the total revenue and divide it by the cost of revenue. So what this tells us is that their revenue is outpacing the cost to make that revenue. And as they continue to grow revenues, their gross profits will grow as well. In the previous earnings report, Palantir shared numerous companies that have benefited from their products. With their products working well and the fact that they are renewing deals, this goes to show how sticky their products actually are. Over time, they will get more and more pricing leverage. If you're the leader in the AI software platform space and you continue to produce great results for your customers, then you will be able to charge a premium as long as the customer's business is thriving. And this not only could help grow revenues, but also gross margins. And this is why I'm excited for Palantir over the next few years. I honestly believe that it is only a matter of time before more and more companies see the power of having products like Foundry. But the next few years will be telling of how well the product does for the existing customers. Lastly, we have profitability. And in a recessionary environment, this is extremely important for investors. There are a couple of metrics to look at when measuring profitability, and they are net income and free cash flow. Personally, when I'm simply looking at companies and trying to figure out future projections, I like using net income. But if I want a deeper analysis or I'm already invested in the company, free cash flow is much more important. Now, Palantir does have a low free cash flow yield of over 1%, but their margins show that they can increase their cash flow much higher than what it is right now. It's clear that their operating loss has continued to improve quarter over quarter, but we will see how much of that will turn into free cash flow as they produce an operating income. In order for Palantir to improve earnings and free cash flow, we need to continue to see revenue grow while their SG&A or selling general and administrative expenses remain low. Now, we may not see drastic changes in free cash flow this year, but I do think that 2024 and 2025, we will be able to see more of a shift to free cash flow, and by that point, revenue growth will continue to remain high. So with Palantir, even though they do have a positive free cash flow, the real profitability will come later. When I think about their products and partnerships 5 years from now, I can't see the company being anywhere near the current share price. They will be well established and their current customers will be using the product for a long time. And so we will see what their track record really looks like. And they continue to bring out new products, which will have an impact on the company in the years to come. Lastly, many large companies thrived in a recessionary environment, and they did that by capitalizing on the opportunities that arose. When you consider the amount of money that Palantir has on the balance sheet, no debt, and a product that the US government plus many commercial companies have seen outstanding results, there is no question in my mind that Palantir will capitalize on any opportunities that arise in the next couple of years. So in terms of what I'm doing, I'm still adding shares. But because this position is already established, I only want to add a few shares here and there. I want to make sure that I have plenty of capital to start new positions in a couple of large cap companies, and I'm finishing my research on those soon. So make sure that you are subscribed to the channel, that way you're notified when new content comes out. Hope you all enjoyed this video, and I'll see you in the next one.